So last night, Nancy Pelosi and the Democrats did plan on having a vote on the House floor to pass Build Back Better. That said, Kevin McCarthy last night did spend a record-breaking 8 hours talking in order to delay a vote on Build Back Better. Now, although he did succeed in preventing a vote last night, they did this morning schedule a vote and did indeed pass Build Back Better. So what happens next? Well, I'm going to talk about that now because this bill now goes over to the Senate where it will not pass as it sits today. So there's a few things to keep in mind about this bill and what we should expect to see as we look to the Senate to pass this bill. Right now, all eyes are on Joe Manchin and Kyrsten Sinema in the Senate. Both these Democrats in the Senate are key to passing this bill once and for all. Because they will be using the reconciliation process, they're only going to need a majority vote. And if all Democrats say yay and all Republicans say no, this will indeed pass through reconciliation as the vice president becomes the tiebreaker. So last night, the CBO was able to expedite and report out their findings on how this bill would impact the deficit. And here's what they came up with. This $1.7 trillion bill would indeed increase the deficit by $367 billion over the 10-year period. This does not account, however, for estimated revenues raised by the increased efforts by the IRS. Now, what those figures are does vary depending on who you ask. The Treasury Department does contend that this will generate $400 billion in estimated revenue, which means it would cover and actually reduce the deficit in that 10 years. However, the CBO says they believe it'll raise an estimated $127 billion, which is about $250 billion short of covering the whole bill. That is equal to the same deficit that we increased by passing the bipartisan infrastructure bill that was signed into law on Monday. If that $250 billion in increasing deficit does indeed come to fruition, that means the infrastructure bill and Build Back Better would increase the deficit by a total of about $500 billion. So at the end of the day, this does come close to covering, but technically this would not cover depending on which figure is more accurate. So with all of that said, it is very likely the Senate will indeed be making changes to Build Back Better. This should not be a surprise, and the current form of this bill is not going to pass as is. So they're going to make some changes, and then this will go back to the House to approve or decline and make amendments to send back to the Senate. So this could take some time, but here's the hope. Whatever changes are made in the Senate are hopefully going to be acceptable by the House so that when it goes back, it can simply be passed and then brought back to the Senate to be put through the reconciliation process. All that said, Congress is targeting Thanksgiving as a go-to date to get this done. Now, we are coming close on running out of money in the U.S. government, so there is a lot of pressure to get this done before then so we can focus on either increasing the debt limit or finding a way to reduce spending. So there's a few areas that are likely to be targeted by the Senate, and here's what we're looking at. First and foremost, the House did increase the SALT tax deduction from $10,000 to $80,000. That's the state and local tax deduction that you're allowed to apply on your federal taxes. They increased it for a period of 5 years of this bill, where instead of $10,000, it would go all the way up to $80,000 that you could write off on your federal taxes. That is likely to get plenty of pushback from the Senate as they look to either lower or remove that altogether. One of the highest single items of spend at $475 billion for 5 years, that SALT tax deduction is looking like a home run for the richest of Americans. However, there are plenty of other Americans in the middle class who could benefit from this deduction. So like some of the other programs that have been added to Build Back Better, it is likely that the Senate could introduce income caps, then onto a very large section of the spend at $550 billion is climate. A big portion of this initiative is targeted at EVs. Right now, that $4,500 boost for union cars is at serious risk. As Joe Manchin has said in the past, we shouldn't use tax dollars to pick winners and losers. It's not the place of government to decide where most of this money should be directed. It should be based on the consumers. So I think what's likely to happen, number one, is that $4,500 boost would go away altogether. And I think that makes sense because we do need to find a way to reduce the deficit as it sits right now. On the other hand, they could change that from a union boost to perhaps a US built boost. If they did do this, it wouldn't matter if it was a union factory or not. As long as the car was assembled here in the United States, it would qualify for that $4,500 boost. So we'll just have to wait and see if they do end up adopting something like this. And then finally, the other large item under scrutiny is undocumented workers. Right now, they have added in Build Back Better. Undocumented immigrants before 2011 would have the ability to apply for renewable employment authorization, and that's at serious risk. This may not be allowed under reconciliation anyways, so even if there was enough support for it, we're going to have to wait to see if this is even allowed utilizing the reconciliation process. That brings us to our final point on this. They need to issue their final determination on which parts are eligible to be permitted. So some of these things that are in Build Back Better are not even allowed to go through the reconciliation process. That said, there's been a lot of work to try to determine before putting it in the bill if it would or would not be allowed. And right now, the undocumented workers piece is probably the most likely to not be allowed, while these other items are somewhat likely to be allowed in the reconciliation process. All that said, these are not the only things likely to come under scrutiny in the Senate and potentially be changed altogether. These are just four of the biggest items that we know about that are very likely to be targeted and to see some changes. As far as it goes for tax credits, I think right now the only issue is the union built piece. If that goes away and the credit itself goes away, I still believe that there's enough support for the rest of the EV package that everything else would stay in place. And if that is the case, there would be up to $8,000 in credits. Now, they could also wipe out that battery boost for US built batteries, and it would just remain $7,500. But at the end of the day, it's now a refundable credit, meaning your tax liability has nothing to do with the qualification of that tax credit. And then the best part of these videos, summarizing to the best of my ability based on your frequently asked questions in the comments. Here we go. This is a 10-year package. It includes 5 years for all EVs. The next 5 years will be only US built EVs. This is effective as of the date of signing or after December 31st, 2021, whichever comes latest. So it'll either be effective on January 1st, 2022, or whatever date this ultimately comes to be signed, which could be January, February, March of 2022. This is not a retroactive bill. I repeat, this is not a retroactive bill. Back in May, the Senate did propose an EV tax credit that was retroactive back to May 24th of 2021. That is not in the language today. That doesn't mean that the Senate doesn't have the ability to add that in there. However, they are trying to reduce costs, so I don't think that's very likely to be reintroduced into this bill. For that, you get a base credit of $4,000 and a $3,500 boost if the battery is 40 kilowatt hours or larger and has less than 2.5 gallon gas tank all the way through 2026. Then in 2027 and forward, it has to be at least 50 kilowatt hours and less than 2.5 gallons. There is, of course, that union boost for $4,500, which is under serious scrutiny right now, and that US built battery for $500 boost, giving you a total of $12,500. This is a refundable tax credit. That means regardless of your tax liability, you will qualify for whatever the maximum is for the vehicle that you have purchased. The income limits are $250,000 for individuals and $500,000 for joint filers. If you make more than those caps, your qualification for credits is reduced by $200 of credit per $1,000 of income above those caps. The MSRP limits are $55,000 for sedans and others, and $80,000 for vans, SUVs, and trucks. Your MSRP includes all options and accessories that you add to the vehicle. It does not include destination fees, taxes, or other fees that are charged by the dealer. And clarification on two specific vehicles. The Model Y is considered an SUV by the EPA, which is going to be used to determine what the qualification of the vehicle is. And the Ford Mach-E is considered a wagon, which would fall under the other category, meaning a $55,000 cap for the Ford Mach-E. For plug-in hybrid electric vehicles, you are qualifying for the same tax credits, at least as it's written today. You get the $4,000 base, a $3,500 boost if it has a 40 kilowatt hour or larger battery with less than 2.5 gallons through 2026. Bring that up to 50 kilowatt hours and less than 2.5 gallons by 2027 and forward. A union boost of $4,500 and a US built battery boost for $500. So you still could qualify for up to $12,500. However, I can't think of any plug-in hybrid electric vehicles today that have a 40 or 50 kilowatt hour battery. So there's not many hybrid vehicles out there that have a big enough battery to get that $3,500 boost. So every plug-in hybrid electric that is at least 10 kilowatt hours or larger will get that base credit of $4,000. Everything else is a boost based on qualifications. For used vehicles, there is a $2,000 credit as long as the car is 2 years old or older and less than $25,000 in cost, and a $2,000 boost if it has a 40 kilowatt hour battery pack up to 2026, and then 50 kilowatt hour battery pack 2027 and forward. The income limit on used vehicles is $75,000 for individuals and $150,000 for joint filers. The way that this works, again, the first year, so presumably 2022, you will not get this credit until you file your 2022 taxes. So in 2023, you would get back that credit, and it would be the full amount of that credit that vehicle qualifies for. Your tax liability does not matter. This is a refundable credit. Starting in 2023, this will then be a point of sale credit, meaning the dealer will take that credit and apply it to your purchase at time of purchase. The other thing that you need to know is, when have you purchased this vehicle? Because that's what matters when it comes to qualifying for these credits. Even if you pre-order a car, you have not purchased the car until you hand a check or sign a loan agreement and take delivery of that vehicle. So even if you have a pre-order in now, you have not purchased that car. So you want to make sure, if you want these credits, to target sometime in 2022, assuming this passes. So there you have it. That's the recap for today. There's a lot of action happening right now, and we hope to see a sense of urgency over this next week leading into the holidays in the Senate. As soon as we get some indication from the Senate of what changes they're proposing to these EV tax credits, of course, we'll provide those updates right here. So make sure you're subscribed. Hit that notification bell if you want to be alerted when these videos go live. I hope that you enjoyed this video. If you did, of course, give it the thumbs up. If you haven't already, of course, subscribe to the channel as we continue to post content regularly. You can follow us on Twitter and Instagram at Bearded Tesla. Thanks so much for joining us, and we'll catch you next time.